A bank can stand still for 30 years, then die in 30 minutes. Not because the money suddenly disappears. Not because the vault evaporates, but because too many people, at the same time, see a truth they were never supposed to see. Their money was never really sitting there the way they imagined. That is when a bank run begins. Not with screaming, not with shattered glass, not with a crowd pushing outside a branch, but with an invisible cue, a message, a post, a tap on a screen, and then fear spreads faster than any bank run in history. This is the part most people do not understand. A modern bank does not survive because cash is sitting there waiting for you. It survives because not enough people demand their money back at the same time. It only takes about 5%. Yes, about 5%. That is enough to turn what looks like a fortress into a math problem no one can save. This video will show you exactly how a bank run starts, why the digital age makes it more dangerous than ever, and when it ends, who actually gets saved. To understand a bank run, you first have to throw away a very common illusion. The illusion that a bank is a place where money is stored. It sounds right. You deposit money. You open the app, you see your balance sitting there. Everything gives you the feeling that your money is being held intact in a safe place, waiting for you whenever you want it back. But that is not how the system works. A bank does not make money by guarding your cash. A bank makes money by moving most of that money somewhere else, lending it out, buying assets, turning the short-term money of depositors into the long-term bets of the system. That is the contradiction sitting at the center of the model. They promise you your money can be withdrawn at any time. But at the same time, most of that money is not sitting there ready for everyone to take back at once. This is not an accident. This is the model, and a bank run is the moment the crowd sees that model exposed for the first time. Picture the system in the simplest possible way. 100 people deposit money into a bank. Each one believes the money is still there, still intact, still theirs, still available the moment they need it. But the bank does not keep all of it in the vault. If it kept 100% in cash, it would barely have a business model. It could not lend. It could not expand credit. It could not generate profit. So from the moment modern banking was born, the system was built on a trade-off. Depositor liquidity exchanged for institutional profit. That is the logic of fractional reserve. The bank knows one thing very well about human behavior. Most people will not withdraw at the same time. Most will leave the money sitting there. Most will trust. And while that trust holds, the system looks perfect. A clean interface, clear balances, smooth transfers. But do not confuse interface with structure. A system can look highly modern on the surface, while its core remains fragile. That is why a bank run is not some rare malfunction. It is the truth test of the entire system. When everything is calm, everyone thinks the bank is strong. Money is coming in. Money is barely going out. Assets are still marked beautifully. Interest rates have not yet punched through the balance sheet. The whole machine looks smooth. But that strength is mostly the strength of normal conditions. A bank run begins when normal conditions die. All it takes is one frightening rumor, one hidden loss coming to light, another bank going down, one article, one tweet. Then a simple question starts spreading through thousands of minds at the same time. If everyone pulls their money, will I be the one trapped at the end? From that moment on, the issue is no longer profit, no longer branding, no longer the image of stability. The issue is speed. Who gets out first? Who gets stuck last? Who still gets money? Who is left with only a promise? A bank run is the moment a bank stops being a financial institution. It becomes a race. Now, for the most unsettling question, why is 5% enough? Because a bank does not need everyone to panic in order to die. It only needs enough people to move fast enough. That is the part most outsiders do not understand. They think collapsing a bank requires a massive stampede. It does not. A bank run does not require the majority. It only requires a minority moving ahead of the crowd. If the bank is holding only a thin layer of liquidity, then the moment a small percentage of depositors starts withdrawing at once, the best assets get sold first. Then the less liquid assets, then realized losses. Then panic accelerates. And once the market smells blood, the cost of saving the system rises by the hour. That is why 5% can be enough. Not because the number is magical, but because, in a leveraged system, what kills you is not the biggest blow. It is the first blow that knocks you off balance. And to understand why the system was built on something this fragile in the first place, we have to go back to the beginning, goldsmiths, and the most dangerous promise in monetary history. To understand why bank runs exist at all, you have to go back to a time when banks were not glass towers with glowing logos. You have to go back to goldsmiths. Back then, people brought their gold to goldsmiths because the goldsmith had a stronger vault, a better lock, and a lower chance of being robbed. In return, they received a receipt, a written promise that the gold was still in storage and could be reclaimed at any time. At first, the model was simple. One person deposits gold. One person keeps it safe. One piece of paper represents what is sitting in the vault. But then the oldest pattern in monetary history appeared again. The custodian noticed that most depositors never came back at the same time. Most of the gold just sat there. And if that was true, why not lend some of it out? Why not issue more receipts than the amount of gold actually sitting underground? That was the birth of modern banking, not from a noble invention, but from a very human observation. Most people will not demand their assets back at the same time. That was the moment the promise began separating from the substance. At first, each piece of paper represented real gold, 100%. If you held that receipt, you could redeem exactly what was in the vault. But once the custodian started issuing more paper than the gold they actually held, the ratio began to crack. 100% became 80, then 50, then lower. And as long as people kept trusting, nothing seemed wrong. The receipts still circulated. Transactions still happened. No one saw the whole because no one pulled the curtain back all at once. That is the most important thing to understand. A bank run does not create fragility. It reveals fragility that was already there. Modern banking is not a larger vault. It is a system that converts trust into assumed liquidity. A system that works beautifully as long as not too many people try to turn promises back into substance at the same time. And the moment they do, history always tells the same story. Trust goes down, speed goes up, the system begins to crack. Over time, the system did not become weaker on the surface. It became stronger on the surface and more fragile at the core. In the old world, people could at least imagine real gold sitting somewhere underground. But in most modern banking systems, you no longer see anything real behind the number on your screen. What remains are layers of financial assets, securities, loans, interbank claims, and balance sheets tied together by trust. That is the journey from 100% real gold in a vault to nearly zero in the digital age. Not because money disappeared from the economy, but because the link between promise and substance became thinner and thinner. That is also why bank runs are even more dangerous today. They do not need bodies. They do not need feet running through the street. They do not need long lines outside a branch. They only need phones, in dinar, and synchronized fear. An app running unusually slow, a leaked email, a perfectly timed tweet. That is enough for the invisible queue to begin forming. And once that invisible queue appears, a digital age bank run no longer unfolds over days. It unfolds over minutes. In the past, the speed of withdrawal was limited by geography. You had to get dressed, leave the house, go to a branch, stand in line, and wait. That physical friction accidentally gave the system extra life. Today, friction has almost disappeared. You do not need to speak to a teller. You do not need to see a crowd. You do not need to witness chaos outside the door. You just open your phone, tap a few times, and tell yourself that you are not panicking. You are simply acting rationally before it is too late. That is what makes the modern bank run more dangerous than every earlier version. It does not need crowds seeing each other panic. It only needs isolated individuals reaching the same conclusion within the same short window of time. I do not need to be first. I just cannot be last. And when tens of thousands of people think that way at once, the system no longer has time to process fear. It only has time to absorb shock. This is where the bank run collides with the balance sheet. As withdrawals accelerate, the bank cannot just sit and watch balances drain away. It has to find liquidity. First, the cash it already has. Then the easiest assets to sell. Then long-term bonds, pledgeable loans, anything that can be turned into money fast enough to close the whole opening in real time. But here is the real problem. Bank assets are usually not designed to be sold in panic. They are designed to be held to maturity or to generate returns under normal conditions. When they are forced into the market quickly, especially while everyone else is also afraid, what once looked safe can turn into realized losses. And once realized losses appear, depositor fear is no longer just rumor. It becomes evidence. That is when a bank run begins feeding itself. Depositors see losses, so they pull faster. The bank sells assets, so the losses grow bigger. Bigger losses make the panic stronger. And to stop that spiral, the system always turns to the last rescuer, the central bank. And that is when the system calls in the lender of last resort. The central bank, in theory, its role is simple. When fear spreads faster than commercial banks can contain it, the central bank injects liquidity into the system to stop the domino effect. It opens emergency lending facilities, expands collateral access, buys time. It sounds like rescue, but look closer. The central bank does not turn bad assets into good assets. It does not erase mistakes. It does not restore trust from the ground up. It simply replaces one layer of fragility with a larger, more political layer of confidence. And that is why the ending of a bank run is rarely clean. It is usually a transfer of fear from depositors to the state, from commercial banks to the central bank, from private panic to system-wide risk. The bank run does not truly disappear. It is moved somewhere else. Then comes the next sedative, deposit insurance. This is the mechanism that tells the public that even if the bank has a problem, their money is still safe. And yes, in many cases, deposit insurance does slow panic. It helps stop a bank run from spreading on pure emotion. It buys time. But deposit insurance is not magic. It does not turn a fragile model into a strong one. It simply tells depositors that if things get bad enough, a larger institution will make a promise on behalf of the smaller one. That is the key point. The system is not made safer at its core. It is wrapped in another layer of reassurance. And when that reassurance is not enough, the next step is bailout. Rescue the bank. Force a merger. Open new liquidity lines. Send the message that the system will not be allowed to die naturally. But every time that happens, the same lesson is reinforced. Profits remain private. The final fear gets socialized. That is how a bank run usually ends. Not with justice, but with dilution. When the system is rescued with new liquidity, new guarantees, and new promises, someone still pays. And very often, the one paying is not the institution that created the original risk. It is society at large, through inflation, through weaker currency, through higher capital costs, through a future that gets quietly shortened. This is the most uncomfortable part of the story. Depositors think they are being saved, but what is really being saved is the structure itself. Confidence is patched. Balance sheets are stretched. Shock is absorbed. And then the bill arrives later, slower, less dramatic, harder to see, but still a bill. That is why a bank run is not just a story about banks. It is a story about money, about promises, about how the modern system keeps postponing the day it faces the truth by pushing the cost into the future. So what is the real lesson? Not that every bank will collapse tomorrow. The real lesson is that what you call safe inside modern banking is, in large part, a psychological experience, an interface, a smooth routine, a habit. That sense of safety exists only as long as most people remain quiet, remain patient, remain trusting. But the moment trust changes direction, speed becomes the killer. That is what this video's title is really about. The invisible queue. Nobody needs to stand side by side. Nobody needs to shout. Each person only needs to reach the same conclusion. I need to get out first. And in a fractional reserve system, that conclusion alone can turn stability into panic within hours. What looks safe is often just familiar. The thing that feels safest is often just the thing that has been running long enough for you to stop questioning it. And a bank run is the moment the questions come back. From here, there are 3 things you need to remember. First, a bank deposit is not cash sitting in a vault waiting for you. It is a claim on an institution that is using most of that money for something else. Second, a bank run does not begin with crowds. It begins with synchronized psychology. Once enough people become afraid within the same short window, the math of the system is exposed. Third, being saved does not mean nobody pays. Many times in history, the price is simply shifted from the present into the future, from depositors to taxpayers, from immediate panic to long inflation. If you remember those 3 things, you already see the system more clearly than most people. A bank run is not a rare event. It is the hidden logic of a trust-based model. And when trust is tested, the only real question is no longer, is the bank okay? It becomes, who gets out first? So what is the playbook? First, do not confuse convenience with safety. A smooth app, a famous brand, a polished branch, or a beautiful interface says very little about liquidity under stress. Second, do not let your entire daily liquidity depend on one single point. In normal times, concentration feels efficient. In unstable times, concentration becomes fragility. Third, understand what kind of money you are holding. Spending money, emergency money, long-term money. Not everything should sit inside the same risk layer, the same promise structure, or the same exit door. Fourth, read what most people never read. Terms, withdrawal rules, transfer delays, the conditions under which transactions can be frozen, reviewed, or restricted. The modern system rarely deceives you with a blatant lie. It deceives you with familiarity. And the price of familiarity usually appears only after things are already late. Your homework is simple. Open your banking app. Read the withdrawal terms. Find the daily limits. Find the conditions under which transfers can be delayed, reviewed, or stopped. Find out whether your money is actually immediately available or whether it is just a legal claim on the system. Then ask yourself a harder question. If an invisible queue started forming tomorrow, would you actually be holding money or only holding the hope that you will not be the last one left behind? This is not a call to panic. It is a call to clarity. Modern banking works not because it is unbreakable, but because most people never examine the layer underneath their normal experience. A bank run is simply the moment that hidden layer becomes visible. And when it does, the people who never ask questions in calm times are the ones who panic hardest. So let's close this video with one simple sentence. Banks do not survive because money is sitting still. Banks survive because not enough people demand it back at the same time. A bank run is the moment trust collides with math. History has seen this before. The tools changed. The pattern didn't. In the past, people ran into the street. Today, they tap a screen. But the nature of the system has not changed. Any structure that promises liquidity to everyone while holding reserves for only a fraction will always contain the seed of a bank run inside itself. So do not just ask whether your bank is big. Ask how much fear it can survive when panic moves faster than money. And in the next video, we go one layer deeper. Not how a bank run starts, but how the system can stop you from leaving once you try. Withdrawal limits, the final door between you and the balance you thought was yours,